The broadest sense is be out of cash, have little or no participation in interest rates, particularly if they're close to zero interest rates, because if the economy goes down, they will offer very little protection to your portfolio because they won't go up much because they're close to zero interest rates. So so you can get a diversified portfolio of assets. And that diversified portfolio of assets can include things like inflation index bonds and stocks and some element of gold and some other assets in different location. Because if you know how to diversify well, you'll find that asset classes, it's not so much that wealth is destroyed as much as it shifts where it is. So by being able to see how it shifts and it moves around and looking at the correlations of those and achieving balance, you can achieve that kind of balance. I created what I called my all-weather fund when I first earned enough money that I knew that I would pass some along and I wouldn't be here. And I believed that active management would be a problem because active management is a zero-sum game. You got to pick the winners and the losers, and most people are not able to do it themselves. And those who are winners get filled up pretty quickly, and so it's not easy to operate that way. So I created this all-weather portfolio, which is a balance. But balance is the key. Diversification of achieving that is the best path, with staying out of the way of cash and looking at one's returns. The most common mistake of investors is to think that the markets that went up are good investments rather than more expensive. And so what you see from, so stay out of cash, achieve the balance, and then don't make that mistake. I remember when the Magellan Fund was the best performing stock mutual funds, when stocks were the best asset class, and a very popular investment fund, but the average investor in it lost money. And the way the average investor lost money is because every time it was up a lot, they bought it. And every time it was down, they sold it. And so they're bad market timing because they were reactive, thinking it's a great investment when it's up a lot and when it's down a lot. And also you see ads that, companies will put out ads, our last 5 years return, or this and that, or this is what the year is, to attract people in. And those are the common mistakes of investors. So don't try to time it yourself because you'll probably lose. Competing in the markets is more difficult than competing in the Olympics. There are more people trying to do it and putting more resources behind it. I know we put in hundreds of millions of dollars a year and so on to try to do that. And it's competitive for us. It's competitive for others. And so to not try to do that yourself, but to achieve balance, like I described in, this all-weather portfolio type of approach. But anyway, what I mean is balance, and not time, and then you rebalance. So if something goes up a lot, and then something goes down a lot, you rebalance to that diversified, and that'll make you sell more as things get expensive and buy more as they go down. And be humble.